Hello and good day to those who are watching our video presentation. Today we are from Group 5 and we are going to present our topic which is about foreign currency operation. Before we begin, I would like to introduce myself and my group member first. My name is Nur Alisha and my group member are Yau Ching Shi, Punitha, Zainal and also Haziq. Our presentation are divided into several parts. The first part is about principle and the type of currency. The second part is about foreign currency transactions and operations. The third part is about transactions of financial statement. The fourth part is about accounting for effect of change in exchange rate. And the fifth part is about disclosure. I'm going to explain the first and the second part. The third part are going to explain by Haziq and also Zainal. The fourth part and the fifth part are going to explain by Punitha and also Shi. Now let's begin with our presentation. As Malaysia grows, a lot of companies will enter into foreign currency transaction. Malaysian companies that have a transaction with foreign company may receive money or make payment in foreign currency. An entity may carry on foreign activity in two ways. The first way is through foreign currency transaction. The second way is through foreign currency operation. According to MFRS 121 Para 8, foreign currency transactions is when a local entity enters into direct business transactions with other entity and the transactions are denominated in foreign currency. There are two types of transaction. The first transaction is short-term transaction and the second transaction is long-term transaction. The example for short-term transactions such as like purchase of raw material and other asset or sales of goods. The example for long-term transactions such as like lending or borrowing in foreign currency. Foreign currency operations is when local entity conduct its foreign currency operations by setting up or invest in branches, subsidiaries, joint venture, and associates whose activity are based or conduct in foreign currency. When companies enter into foreign currency transactions, they may face this issue. The first issue that they may face is what rate of exchange should be used, and the second issue is what should be the appropriate accounting treatment. These are the terms that we need to understand before we go for further explanations. According to MFRS 121, exchange rate is the ratio of exchange for two currency. Spot exchange rate is the exchange rate for immediate delivery. Closing rate is the spot exchange rate at the end of the reporting period. Exchange difference is the difference resulting from translating a given number of units of one currency into another currency at different exchange rate. Fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transactions between market participants at the measurement date. The next term is monetary items. Monetary items are units of currency held, an asset and liability to be received or paid in the fixed or determinable numbers of units of currency. Examples of monetary items such as like cash, bank account, receivable, payable, lending, and borrowing. While non-monetary items are subject to a change in value and cannot be quickly converted to cash. So for example of non-monetary items such as like property, plant and equipment, intangible asset, and equity investment. The last term is net investment in a foreign operations. Net investment in a foreign operation is the amount of reporting entity interest in the net asset of that operations. According to MFRS 121, there are three types of currency. The first one is functional currency. Functional currency is the currency of primary economic environments in which the entity is operated. The second one is foreign currency. Foreign currency is the currency other than functional currency of the entity. The third currency is presentation currency. Presentation currency is the currency in which the financial statements are presented. Each individual entity, whether it's a standalone, parent, branch or subsidiary, need to determine its functional currency and measure its result. Moving on to the next slide, we are going to see factor determining functional currency. So for the primary indicator, the factor that need to be considered is currency. the currency that mainly influences price for goods and services. The next one is the currency of the country whose competitive force and regulations mainly determine the sales price of its goods and services. For better understanding, let's see this illustration together. Duwita Manufacturing Berhad is a foreign operation. Sensory Berhad, an incorporated company in Brunei. Duwita Manufacture has been in operations in Malaysia for 5 years, and its main customer other than Sensory Berhad is Almarat Company, which is a company incorporated in Arab Saudi. So goods produced by Duwita are sold in Malaysia and other countries. Financing sources in Malaysia ringgit for Sensory Berhad is 5.5 million. For Saudi Arabia is 25 million and Malaysian baht is 8 million. Identify the functional currency for Duwita. For this example, the currency will be Saudi Riyal, as the one that had the most sales will determine the sales price because that is where the majority of the customer are. So the next one, still under the primary indicator, the factor that need to be considered is the currency that mainly influences labor, material and other costs of providing goods and services. Let's see the examples for these situations. Company C make sales all around the globe, but its production facility are in China. So for this example, the functional currency will be yuan because this is the currency that influences labor, material and other costs. Under the secondary indicator, the factors that need to be considered are currency in which fund from financing activity, the currency in which receipt from operating activity are retained. We are going to see the illustrations. Company D has its head office and all of its cost incurred activity in UK, but all of its customers are in India. Its bank accounts are held in sterling, which is also the currency of its share capital and its bank loan. So for this question, if we look at the sales, functional currency will be rupee. But if we look at the cost, suggest that sterling will be appropriate. So for this question, they will turn into supplementary indicator, which will lead to conclusion that the functional currency is sterling because this is the currency in which cash is retained and fund is raised. The next slide is about additional factor determine relationship between parents and foreign operations are degree of autonomy, volume of transaction, degree effect on cash flow, and debt services. Let's see this illustration together. Company Q has two subsidiaries which are R and S. R is based in US and it has its own management team and supplier contact. So it's buying and selling process in USD. R also acting autonomously, while S is based in France and effectively act as distribution agents for Q. It purchases inventory from Q rather than directly from supplier, and most of its logical decisions and its selling price are determined by Q. So for this question, our functional currency is likely to be USD based on analysis of its operations, while for C, functional currency is probably sterling because majority of the decisions are determined by Q. If indicators are mixed and functional currency is not obvious, management should use its judgment to determine which functional currency is represented most faithfully. It shall give priority to primary indicator before considering other indicator. Exchange exposure is important as Malaysian companies that enter into foreign transactions and operations are subject to it. So this exposure is the risk of exchange losses of gains from foreign currency arising from the result of fluctuating exchange rates against Malaysian ringgit. From this table, we can see that if Malaysian entity hold asset and the asset is denominated in foreign currency and appreciate against the Malaysian ringgit, the exchange gains will acquire. While if the foreign currency is depreciated against Malaysian ringgit, the exchange losses will arise. Next, if Malaysian entity has liability and the liability is denominated in foreign currency, such as like foreign trade payables, and it appreciates against Malaysian ringgit, so exchange losses will acquire, and if the foreign currency is depreciated against ringgit, exchange gain will arise. Note that when Malaysian entity has branches, whether it's locally or overseas, each branch shall determine its functional currency and report its result. That's all from me. I'm going to pass this presentation to next presenter to continue with presentation.
Thank you, Alisha. And now I will explain further about translation of financial statement of foreign operation. Generally, there are two major events in translating financial statement of foreign operation. First one is translation to functional currency. The second one is translation to the presentation currency. Okay, let's move to the translation to functional currency first. Generally, when there is a change in an entity functional currency, the entity shall apply the translation procedure applicable to the new functional currency prospectively from the date of the change. The functional currency of an entity reflects the underlying transaction, event, and condition that are relevant to the entity. Once the functional currency is determined, it can be changed only if there is a change to those underlying transaction, event, and condition. This part will expand further at Punitha and Shi part. Translation to presentation currency, the second major event. Generally, it permits the entity to present its financial statement in any currency. In addition, it permits the company entity to present its financial statement in more than one currency. So, the translation method used is closing rate method. Basically, the closing rate method will be based on MRFS 121, paragraph 39. Okay, this is the procedure of the closing rate method, which is based on MRFS 121, paragraph 39. Okay, firstly, it will translate all items of financial position, including the allocation of goodwill at the closing rate, except for share capital and pre-acquisition reserve, which should be translated at their historical rate. Second, translate all items of income and expense in profit or loss at the average rate or accounting policy required. Third, return profit brought forward should be based on the prior year post-acquisition profit in the presentation currency, for example, ringgit Malaysia. Next, you can produce the consolidated statement of financial position and the statement of profit or loss and other confiscated income using the normal consolidation procedure. Last, you need to prove the total exchange difference as follows. The first one, the net asset and goodwill at the acquisition date translated at closing rate minus the net asset and goodwill at acquisition date translated at
Their historical rate, next year-to-year increase in net asset, for example,
return profit for each year, translated at closing rate to their year-to-year reported amounts in ringgit. Next, the third one, any reversion surplus arising during the year translated at the closing rate minus the amount translated at the date of the recognition. This is the exchange difference can arise from three sources when the closing method is used. This is the short that I can explain to you from the previous slide. Okay, there are three exchange difference can rise from three sources, which is first is opening net asset at opening rate. Second, profit for the year at average rate. Third is revaluation surplus at rate on revaluation date. This is the example illustration. You can pause if you want to read further. Have you read about the question? Let me read again. Assume that Faiz Berhad, whose functional currency was the Malaysian ringgit, incorporated a whole owned Bin Berhad in Singapore on 1 January 2020. The paid-up capital of Din Berhad was Singapore dollar 20 million, and Vice Berhad paid the investment on that date. Din Berhad was classified as a foreign operation. The exchange rate ruling on 1 January 2020 was RM2 per unit of Singapore dollar. The relevant exchange rate per unit of Singapore dollar were as follows. At average of the year, there is 2 ringgit 40 cent. At 30 September 2020, 2 ringgit 60 cents. At 31st December 2020, which is at 2 ringgit 80 cents. So, the question is you need to identify the sources of the exchange difference. So, the first situation, if Din Berhad made zero profit for the first year ended 31st December 2020 and its net asset at year end remained at Singapore dollar 10 million. So, the exchange difference sources is only at opening net asset at opening rate since there is no profits and revolving surplus at that situation. Second situation, Din Berhad made Singapore dollar 5 million profit for the year ended 31st December 2020. On 30th September 2020, it revalued upward a property with a book value of Singapore dollar 2 million to Singapore dollar 5 million. Its net asset at year-end was Singapore dollar 80 million. So the exchange difference sources is opening net asset at opening rate, profit for the year at average rate, and third, reversion surplus at rate on revenue rate. Because they made profit, they have reversion surplus, and that is opening net asset at opening rate. Basically, this question you can refer further in Tanya Tombo to further calculate the question. Okay, this is the summarize for the closing rate method versus template rate method so that you can more understand and you can differentiate between this method and you can more easy to apply in any situation of the consolidated financial statement. Okay, by using closing rate method on the balance sheet, the monetary item and non-monetary item use current rate. However, for the equity element, use historical rate. For the income statement, for the revenue and expense not related to monetary asset and revenue and expense related to monetary asset they both use average rate. So, as for temporary rate method, they use for balance sheet, the first one, monetary item use current rate. However, for non-monetary item and equity element, they both use historical rate. Under income statement, for the revenue and expense are not related to monetary asset, use average rate. And revenues and expense related to monetary asset, use historical rate. And now I will pass the presentation to Haziq Hazwan bin Husainizam.
Thank you, Zainal. Now, I will continue this presentation by explaining integration operation, changes requirement in MFRS, translation of goodwill and fair value adjustment of a foreign operation, and some illustration. Now, I will be explaining integral operation. When a Malaysia overseas subsidiary has a functional currency of the Malaysian ringgit, it is a foreign operation whose economic environment is primary in the Malaysian ringgit. Under original IAS 21 stated that such operation is known as an integral operation of the Malaysian parent. However, this IAS 21 is no longer be used. In fact, MFRS 121 will be used for all the requirements. This explanation will expand further in the next slide. Below here is a reflection of a Malaysia overseas subsidiary. If the account of the overseas subsidiary are kept in ringgit, they would be consolidated directly without any further issue of translation. However, if their account are kept in the local currency, which is not in ringgit or ringgit Malaysia, a remeasurement using the temporal method is required. This illustration also will be explained further in the next two slides. Next, I will be explaining the changes from the original IAS 21. Here, MFRS 121 changes the requirements of the original IAS 21 by not distinguishing between integral foreign operation and foreign entities. Instead, all overseas subsidiaries, branches, associates, and joint ventures are now classifying as foreign operation. As a result of applying the functional current concept, there is no longer a distinction between integral operation and foreign entities. Instead, an entity that was previously classified as integral foreign operation will have the same functional currency as the reporting entity. Then only one translation method is prescribed for foreign operations such as closing rate method that was applied to foreign entity under the original IAS 21. Next, I will describe accounting record not kept in the functional currency. Firstly, if the company kept record in its functional currency, for example, Ringgit Malaysia, and Ringgit Malaysia is its functional currency, so no need translation should be done. However, if the company is not kept record in its functional currency, such as record in Ringgit Malaysia, but their functional currency is in US dollar, they need to use temporal method which is stated in para 23 of MFRS 121 by translating the financial statement to its functional currency which is in US dollar. Next, if the company's functional currency is not equal with its presentation currency, closing rate method should be done which is stated in MFRS 121 para 39 to translate the financial statement from functional currency to presentation currency. Next, this situation 1 and situation 2 will describe on what I explained just now. For situation 1, Salma Sedian Berhad is a Malaysian company registered in Malaysia and the functional currency is in USD. Salma Berhad keep the record in Ringgit Malaysia. So remeasure using temporal method understated para 23 needed which the company must translate financial statement in Ringgit Malaysia to USD because its functional currency is USD. In here, Salma Berhad also used the original accounting record in RM to report to SSMs. If Salma Sedian Berhad is the subsidiary of Anita Berhad, which is the parent company, is located in Malaysia, and Anita Berhad keep the record in Ringgit Malaysia, Salma need to translate from USD to RM for consolidation purpose. So closing rate method which is stated in MFRS 121 para 39 need to be done by Salma to translate financial statement in USD to RM where RM is the presentation currency for Malaysian parent company and for consolidated purposes. The next situation is the continuity from the situation 1. Here, Anita Berhad has another subsidiary company named Rose Sedian Berhad in Philippines, and the company registered in Philippines. Anita functional currency is in US dollar, while Rose functional currency is in peso. Therefore, if Rose Berhad keep record in peso, the company need to remeasure it by using temporal method stated in para 23 to translate financial statement in peso to USD because USD is their functional currency. By doing that so, it will result in financial statement in USD. For consolidated purposes with Malaysia company, Rose Berhad need to use closing rate method stated in para 39 to translate financial statement in USD, which functional currency for Philippines company to RM, where follow the presentation currency for Malaysia parent company. Here, it will result the financial statement in RM. Now, I will discuss about translation of goodwill and fair value adjustment of a foreign operation. Generally, goodwill and fair value adjustment arise only at group consolidation level when the permanent adjustments are performed. And because they arise on consolidation, past practices prefer to treat them as asset of the parent and therefore measure or translate them at their historical rate. However, there is issue here whether goodwill and fair value adjustment of a foreign operation should be treated as asset and liability of the foreign operation, in which case they should be treated as asset and translate at the closing rate, or asset and liability acquired by the local parent company, in which case they should be recorded at their historical cost. The original IAS 21 permitted either treatment. However, we follow the requirement from MFRS 121 and Malaysian Private Entities Reporting Standard. They state that any goodwill arising on the acquisition of the foreign operation and any fair value adjustment to the carrying amount of asset and liability of that foreign operation shall be treated as asset and liability of the foreign operation. Thus, they shall be expressed in the functional currency of the foreign operation and shall be translated at the closing rate. Please take note that it is still necessary to use the historical rate to translate the share capital and pre-acquisition reserve so that the original goodwill on combination can be established. Then the resulting goodwill and any fair value adjustment are then translating at the closing rate. This is an example illustration for translation of goodwill and fair value adjustment of a foreign operation. ABC Berhad acquired a 75% interest in the equity capital of PQR Ltd on 1st January 2004 for a consideration 30,250,000. On this date, the book value of the net asset of the PQR Ltd was $10 million. The net asset of PQR Ltd was assessed to have a fair value of $15 million on this date. Assume that PQR made exactly a nil profit for the year ended 31st December 2004. The exchange rate on 1st January 2004 was 2 ringgit 20 cent to 1 unit of US dollar, and the rate of 31st December 2004 was 2 ringgit 50 cent to 1 unit of US dollar. So here, 2 ringgit 20 cent is a historical cost, while 2 ringgit 50 cent is a rate for the closing rate. Therefore, all the book value of net asset, fair value adjustment, and goodwill on acquisition must be calculated using closing rate, while the share capital and pre-acquisition reserve of the foreign operation must be calculated by using historical cost. You also can refer to the Tang Liao Tong book, pages 895 to know fully calculation for this question. That's all from me now. The next presenter, which is Yau Ching Shi, will continue with this presentation. That's all from me. Thank you.
Thank you, Haziq, for the explanation just now. My name is Ching Shi, and let me continue this presentation by presenting content 4, accounting for effects of changes in exchange rate. By referring to the lesson development, I will be in charge on presenting subcontent number 1 until 4. Okay, for the initial recognition, MFRS 121.21 requires that on the transaction date, every asset, liability, revenue, or expense item that arise from the foreign currency transaction should be translated into the functional currency using spot exchange rate. I believe everyone already know about the meaning of the terms that I mentioned just now. Okay, let's move on to the example for a clearer explanation, understanding. Okay, on 30th June 2021, Hai Berhad, whose functional currency is Malaysian ringgit, undertook the following foreign currency transaction. Okay, the transaction tree here. I will go into deeper explanation later on. Okay, on that day, the exchange rates were quoted as follows. Okay, Malaysian ringgit per unit of foreign currency. So we have UK pound sterling here, Australian dollar, and also here South Korean won. But South Korean won here is a bit different due to the nature of the currency, and I will show you the calculation later on. Okay. The solution here. Okay, this question requires us to form the journal entry. So, okay, let's look into the first transaction. Sold goods on credit to a customer in the United Kingdom for an invoice amount of UK pound sterling of 60,000. So we will need to debit the foreign trade receivable account and credit the sales account. But which rate that we will need to choose? The exchange rate is this one, buying rate. Due to the question itself is a selling transaction, therefore we will be using the buying rate. Okay, I forgot to tell is that this is the selling and buying rate of the bank. Okay, so we will be choosing this rate, and then here we will be times this rate with the currency, and therefore we will be resulting in this number. And this is to record the sales to a foreign customer. Okay, while for the second transaction, purchase raw material on credit from a supplier in Australia for an invoice amount of 80,000. Okay, so the rate first. Okay, the rate here will be taking the selling rate due to this is a purchase transaction. Okay, so we'll be tagging this one, and then after we times it, it will be resulting in this number. This is to record the purchase of goods from a foreign supplier. And last but not least, the transaction will be obtain a South Korean won long-term loan of Korean won 500 million. So let's see. Okay, we will take the 500 million won times with the rate. This rate will be taking the selling rate here, 0.3855, and we will times with 1 over 100 or divide it with 100. Okay, this will result in the same number, and this is the answer. And therefore, we will be debiting the bank account since we will be receiving the money, and we will be credit the foreign currency long-term loan. This is an liability. This is a liability, and this is to record the won loan obtained. Okay, we need to take note that remember, bank will buy low and sell high to earn the spread of the foreign exchange services that they provide to their customers. So the price here is high and the buying price will be low. Okay, let's move on to the next sub-content. Okay, and in any reporting period, many foreign currency transactions may have been settled prior to or at the end of the reporting period, and this will be termed as realized foreign currency transaction. And a realized exchange difference will arise when the exchange rate that we initially recorded is different with the exchange rate at the settlement or realization date, and this will be recognized as the gain or loss in P&L. Okay, the example of question is the same with the previous example, and however there will be an additional information here. The foreign trade receivable of UK pound 60,000 was collected on 31st of August 2021, meaning that 2 months afterwards, and the spot per unit of UK pound was RM 5.06010. Okay, and the solution here. Firstly, we'll need to calculate the exchange difference. So as you can see, this one is the same with the previous example. We will use the same rate. Here, see. Okay, and the settlement. Well, during the settlement date, we will be using the same rate as given by the question, 5.6010, and after we times it, we will be resulting in this number. And the difference here the difference between these two number will be resulting in realized exchange loss due to the hybrid will be collecting will be receiving a lesser money during the settlement date. So for the journal entry, we will be debiting the bank account with this sum and debit the exchange loss in profit or loss. Okay, the loss, and then credit the foreign trade receivable account, which is 342480, the earliest one. This is to eliminate the trade receivable. Okay, this is to record the settlement of trade debt and loss on exchange. Okay. Okay, let's move on. Okay, according to before I try to explain about the presentation slide here, I will be providing some additional information. Okay, some foreign currency transactions may remain unsettled at the end of the reporting period, meaning that it will be brought forward to the next financial year. And MFRS 121 Para 23 have provided guidelines for the purpose of measurement of this type of transaction. So the MFRS 121.23 consists of 3 subtopics here as subpara, and A is for monetary items, and B and C. For B and C is for non-monetary items. Okay, so Para 23A required that the foreign currency monetary item shall be translated using the closing rate. And if the exchange rate, which is initially recorded, is different with the exchange rate on the financial year end, it will give rise to unrealized exchange differences. Okay, let's see. Okay, while for the non-monetary item, okay, B, as we can see here, the non-monetary item that are measured in terms of historical cost in the foreign currency shall be translated using the exchange rate at the date of the transaction. However, need to take note that unless it is fluctuate significantly. While for C, non-monetary items that are measured at fair value in a foreign currency, meaning that remeasurement happens lah. And then it shall be translated using the exchange rate, at the date where the fair value was measured. Okay, therefore, with these two, it will conclude that no exchange difference will arise on the translation of non-monetary item. Okay, let's move on to the next sub-content. Okay, according to MFRS 121 para 28, exchange differences that arising on the settlement or transaction of monetary items shall be recognized in the profit or loss in the period in which they arise. However, with exception, there is an exception in which this will be explained in the later part by our next presenter. Okay. And well, for the non-monetary item, we will need to refer on MFRS 121.30. It mentioned here, if the gain or losses is recognized in the P&L, the exchange differences will also recognize in P&L. And on the other hand, under the same para, if the gain or loss is recognized in OCI or other comprehensive income, the exchange rate difference would also recorded in OCI. Okay, let's come to the last example of question. We will be continuing, okay, using the same situation. Okay, and okay, the additional information here. This is an example for monetary item para 28. Okay, so the South Korean won loan was for a period of 5 years. The bank selling spot rate per 100 units of Korean won at 31st of December 2021 was RM of 0.3920. Okay, so this is the financial year end. So for the calculation, we will be using the same. Okay. So, or however, we'll need to take note that the rate is per 100. So remember, with the method that I presented before this, we will need to like times 1 over 100 or divide by 100. Okay, so for the balance sheet date, 31st of December 2021, the retranslation will be 500 million won, still the same currency. We will times with this one and then divide by 100. Okay, so we will be resulting in this number. So the difference between these two will be resulting in unrealized exchange loss. This is due to the amount at the balance sheet date is higher. Therefore, we will like presume that we will need to pay a higher loan. Okay. So as for the journal entry, the debit will be exchange loss in profit or loss. This number, the loss here, and then credit the foreign currency long-term loan. Okay. So this is to recognize the exchange loss. Oh, okay. But if it is an exchange gain, we will be debiting the foreign currency long-term loan and credit the exchange gain in profit or loss. So we will use this method. We will use this. We'll record it like this if it is to recognize the exchange gain. Okay, that's all from me, and I will pass to the next presenter, which is Punitha. Thank you.
Thank you, Xingxi. Now I will present about functional currency that is not a local currency. If a Malaysian company has a functional currency other than the Malaysian ringgit, the above translation and recognition principle should be applied in that functional currency as well. For example, if the functional currency is US dollar, then the result of statement of profit or loss, other comprehensive income, and statement of financial position should be measured in that USD dollar as well. Logically, the accounting record should be kept in US dollar. However, if the local laws and regulation require that the accounting record must be kept in Malaysian ringgit, then ideally two sets of accounts must be maintained, which referred as a dual system of accounting, which means one set kept in Malaysian ringgit to comply with local laws and the other set kept in US dollar to comply with MFRS 121. Now, let us look into the example of question for better understanding. So the question here is, Big 8 Music Berhad, a local firm with a USD functional currency, conducted the following transactions during the month of June 2021. There are three transactions here. We will look into that one by one. On the 1st June, Big Eat Music Berhad sold goods to a company in New Zealand for invoice amount of USD 130k. On this date, the spot exchange rate was New Zealand dollar 0.7310 cent to 1 ringgit US dollar. The second transaction was on 13 June. Big Eat Music Berhad purchased raw material for a company in Canada for an amount of Canada dollar 220k. On this date, the spot exchange rate was Canada dollar 1 ringgit 43 cent to 1 ringgit US dollar. And the third transaction is on 25th of June. Big Eat Music Berhad deposited 3 million in fixed deposit with a Malaysian bank. On this date, the spot export date was 4 ringgit 52 cent to 1 US dollar. So all the above transactions remain outstanding on 30th June 2021. The spot exchange rates per 1 US dollar on this date were as follows. So So in this question, we have to take note that the Big Eat Music Berhad's functional currency is US dollar. So all the transaction need to be stated in US dollar in financial statement. So let us look into the journal entries. So on 1st June, the debit is trade receivable and credit is sales amounted US dollar 130k. It is to record the sales in functional currency. On 13 June, the debit is purchase account and credit is trade payable. We have to record the purchase in US dollar. In order to record the purchase in US dollar, we have to translate the Canada currency to US dollar. So we have to take the rate at the date of transaction, which is 1 ringgit 43 cent of Canada dollar, and we have to divide it on the total amount of the purchase, and we will get 153846 US dollar. And then on 25th June, to record the placement of deposit, we have to translate it to USD dollar as well, because the transaction is in Malaysian ringgit. So in order to translate the 3 million to US dollar, we have to take the exchange rate at the date of transaction, and we have to divide by the total deposit, and we will get 663717. As for the reporting as at 30th June 2021, for the first transaction, which is on 1st June, no change is required as this is not a foreign currency transaction, because the sales itself is in US dollar, so we don't have to translate it. We just straight away record it. For the second transaction, trade payable is translated at closing rate. The rate is given in the question on 30th June 2021. These are the rates. So we will translate the purchase amount, which is in Canada dollar amounted 220k, into US dollar using the closing rate. So it gives rise to exchange gain. This highlighted amount is This highlighted amounts translated using the rate at the date of transaction, and this amount translated using closing rate. So the difference between these two, we will get the exchange gain, which is 8151 US dollar. As for the third transaction, it is quite similar with the previous one. We have to get the difference between the rate on the date of transaction and the closing rate. We have to calculate the exchange gain in profit or loss. So moving on to the next slide. Now, let us look into net investment in a foreign operation. The exchange differences arising on a monetary item that forms part of a reporting entity's net investment in a foreign operation should be recognized in profit or loss in the separate financial statement of the reporting entity. In the financial statement that include foreign operation and the reporting entity, which referred as consolidated financial statement, when the foreign operation is a subsidiary, such exchange differences shall be recognized initially in other comprehensive income and reclassified from equity to profit or loss on disposal of net investment. It is stated in MFRS 121 under paragraph 32. The long-term monetary items include loan and advance, long-term payable and receivable. If there is no intention of immediate settlement or realization of these monetary items since they are part of the net investment in foreign operation. So the entity do not include the trade receivable and trade payable for which settlement is expected. So, as translation of foreign operation under the closing rate method will result in exchange differences being recognized initially in other comprehensive income and retained in a separate component of equity. Exchange difference arising on translation of these long-term monetary items should similarly be recognized in comprehensive income and retained in equity at the group level as represent part of net investment in the foreign operation. The exchange differences recognized initially in the other comprehensive income should be classified as separate component referred as exchange translation reserve in the statement of changes in equity. Now, let us look into the example of question. On 1st January 2021, I Berhad, with a functional currency of Malaysian ringgit, established a wholly owned subsidiary of BTS in Penang with a paid-up capital USD 7 million. Hai Berhad applied the cost model to account for investment in subsidiaries. On the same day, Hai Berhad extended to a long-term advance of USD 3 million to BTS. The advance was considered to be part of the net investment in BTS as it was not intended for settlement in the foreseeable future. BTS functional currency is US dollar. Assume that for the year ended 31st December 2021, it recorded exactly zero profit. So these are the exchange rate given between ringgit Malaysia and also US dollar. So the question is, we have to calculate and explain how the exchange differences should be dealt with in separate financial statement of Iberhut and its consolidated financial statement for the year end to the 31st December 2021. So let's see the solution. So we have to take note that the Iberhut's functional currency is Ringgit Malaysia and BTS functional currency is US dollar. So in Iberhut's separate financial statement, investment being non-monetary item would be carried at its cost of 25.2 million, which is translated at the historical rate of RM3 ringgit 60 cent. So no exchange differences would arise in this. So advance being a monetary item should be translated and carried at the closing rate amount 11.7 million. So the gain arising is 900k. So we have to compare between the rate at the date of transaction and the closing rate with the total amount. And it would result in exchange gain in profit or loss. So in the individual account of BTS, the US dollar advance from its parent is not a foreign currency transaction, so no exchange differences would arise. High Berhard's group level, which referred as consolidated financial statement, the total exchange gain recognized in other comprehensive income and retained in exchange translation reserve in the consolidated financial statement would be 3 million. This is the total of non-monetary item and monetary item with the difference between the closing rate and the rate at the date of transaction, and it would result in 3 million of exchange gain. So let us look into the next example. The long-term advance was denominated in Malaysian ringgit in the amount of 10.8 million. Calculate and explain how the exchange differences should be dealt with in the individual financial statement of BTS and the consolidated financial statement of Hype Berhad. So the solution is translation to the functional currency of BTS. So the advance obtained is 10.8 million, and this is the rate at the date of transaction, and this is the rate, the closing rate, and the differences would be the gain on translation at the year end. In BTS individual financial statement, the exchange differences of 23,769 US dollars should be recognized as gain in profit or loss. As for I Berhard's group level, which is the consolidated financial statement, gain shall be reclassified, recognized in other comprehensive income, and retained in exchange translation reserve. So there are two ways of calculation. The first one is the same as the previous one, which we used in this example in getting this 3 million. And the second one is we have to take note that the net asset of BTS would increase to 7,023,769 US dollar. So for the 31st December net asset, we have to use the closing rate, and we have to translate into ringgit Malaysia. For the opening net asset, we have to use the rate at the date of transaction, and into the we have to translate it to ringgit Malaysia. The differences between net asset and opening net asset will result in groups gain recognized in other comprehensive income, which is 3 million. So both method will result in same amount, which is 3 million. So moving on to the next slide. Monetary items that forms part of the parent's net investment in foreign operation may be denominated in a currency other than the functional currency of the parent or the foreign operation. So let us see the example. On 1st January 2021, Purple Berhad, whose functional currency was the Malaysian ringgit, extended a loan of USD 1 million to its subsidiary Yellow. The loan was part of net investment in Yellow. The subsidiary company operated mainly in Taiwan, and its functional currency was New Taiwan dollar. So these are the exchange rate movements as follows. So let us see the solution. So we have to take note that the Purple Berhad's functional currency is Ringgit Malaysia, and Yellow Berhad's functional currency is New Taiwan dollar. So in the separate account of Purple Berhad, loan to subsidiary 1 million, at on 1st January we have to take the rate on 1st January, and it will result in RM 4 million. And on 31st December translation at year end, we have to take the rate at the year end on 31st December, and it will result in 3.5 million ringgit Malaysia, and the difference between the 1st January 2021 rate exchange rate and 31st December 2021 exchange rate will result in exchange loss recognized in profit or loss amounted 500k. In the individual account of Yellow Berhad, we need to use the rate of New Taiwan dollar, and then the loan from parent is 1 million, and we have to use the rate on 1st January, and at the translation at year end we have to use the rate at 31st December, and the difference between these two will result in exchange loss recognized in profit or loss, which is 2.5 million. And in consolidated financial statement of Purple Berhad, the parent's loss reclassified and recognized in other comprehensive income, which is 500k, and the subsidiary's loss reclassified and recognized in other comprehensive income. We have to this is the rate for the Malaysian ringgit, and this is rate for the Taiwan New Taiwan dollar at the on 31st December 2021, and then we will get the subsidiaries loss reclassified, and we will record the total exchange loss recognized in other comprehensive income. Now we will look into the changes in functional currency. When there is a change in entity's functional currency, the entity should apply the translation procedure applicable to the new functional currency prospectively from the date of change. Take note that determination of entity's functional currency must be based on the underlying transactions, event, and condition that reflects the primary economic environment in the entity operates. So an entity changes its functional currency only when the underlying economic environment has changed. For example, changes in the currency for sales of good may lead to a change in an entity's functional currency. So moving on to the next slide, which is on disclosure. So for the disclosure, an entity should disclose first the amount of exchange differences recognized in the profit or loss. Second, the net exchange differences recognized in other comprehensive income, which includes accumulated in a separate component of equity, and a reconciliation of amount of such exchange differences at the beginning and the end of period. Next, when the presentation currency is different from the functional currency, the entity should state it and make disclosure of functional currency and the reason for using a different presentation currency. When there is a change in the functional currency of either the reporting entity or a significant foreign operation, that fact and the reason for the change in functional currency should be disclosed. Besides, when an entity presents its financial statement in a currency that is different from its functional currency, the entity should describe the functional statement as complying with MFRS only if they comply all the requirement of MFRS, including the translation method. So moving on to the next slide. When an entity displays its financial statement or financial information in a currency that is different from either the functional currency or presentation currency, the entity should first clearly identify the information as supplementary information to distinguish it from the information that complies with MFRS. Second, the entity should disclose the currency in which the supplementary information is displayed. Third, the entity should disclose the functional currency. Third, the entity should disclose the entity's functional currency and the method of translation used to determine the supplementary information. Thank you for listening to our presentation. I hope this video could help you guys to understand more about foreign currency operation. Good luck.